podcast. Welcome back. My name is Arya and I don't waste your time, so let's get straight into it. Ladies and gentlemen, the Department of Justice is coming after Google with intent of breaking this business apart into a million pieces, and Google's going to zero because, of course, it's guaranteed. Just because the CNBC headline told me that they're going to split the company apart, it's going to go to zero. We should send the stock down. Of course, I'm being a little bit sarcastic here, but nonetheless, it's a very valid concern to be worried that the Department of Justice is going to rule in favor of breaking this business apart. What is the material risks that are coming from that if they're forced to, sell components of this business? Well, who would that be sold to? And probably if we were to condense it down to literally just one question, how will the moat of Google be affected if any of these rulings were to go through? And so that is what we'll be tackling in today's video. We're going to look at the current timeline of Google, what has happened, what is going to happen, what is the exact fine print and the rules involved with this, what are some historical examples of similar things happening to other companies, and what was the outcome over there. And of course, towards the end of the video, I'm going to kind of give you the two sides of it, what I like to call the narrative-based side of things, such as the headlines and the scares and all that type of stuff. And of course, actually looking at the numbers, looking at the fundamental drivers of this business, what has happened and how is Google developing right in front of our eyes. Now, before we move on here, I do want to give a quick shout out to finchat.io. You'll hear from them later on in the video when we do the fundamental part and all that type of stuff. Now, I put a quick tweet out earlier, I think yesterday actually, and I talked about how, the part of the business that doesn't generate any revenues and is completely useless if we detach it from the core search business, we might have to sell that for $15 to $20 billion. What a absolute travesty that would be if Google would, essentially earn $20 billion out of thin air. Of course, a little bit of sarcasm at play there, but still, this is a very valid risk factor towards Google, whether it would actually be split apart and how would that materially affect the business. And so to kind of establish the rules up front here, just so we're on the same page, it's actually completely legal for a company, any company, to be a complete monopoly on whatever it is that they're selling. That's completely fine. The part where it gets tricky and the part where you're not allowed to cross the red line would be that if you're abusing that monopoly power. So if you're the sole provider of, for example, insulin, that's completely fine as long as you're not increasing prices tenfold and literally abusing the monopoly power that you're the only manufacturer of that insulin. Same goes for Google. Google, it's completely fine that you have a total monopoly on search, but if you are in some way abusing that power and at the end of the day it's bad for consumers, then there's a very valid case for the government to step in and actually regulate Google in some capacity to prevent them from abusing that monopoly power. And so what better way to try to kind of digest what is going on with Google today than to look at the most recent historical example of another big tech company being deemed by the Department of Justice as a total monopoly on that they're selling, and what was the ruling and settlement that came after that. So instead of speculating on what might happen in the future with Google, what if we just look at the best historical example that we have? Of course, I'm talking about Microsoft in the 2000s, which was deemed actually probably a bigger monopoly than what it is we have with Google today. And so actually provided to us by the Google AI overview. I'm actually loving this feature. Every time I search in Google, it kind of gives me the rundown. I don't have to scroll and look through the thing. Topic for another video. And so based off of the Google AI overview, it says that the outcome of the US Department of Justice antitrust lawsuit against Microsoft was a settlement between the two parties. And so in 2000, Judge Thomas, whatever, ruled that Microsoft violated the Antitrust Act by monopolizing essentially just the personal computer. x86 is the architecture for the type of computers that are made. It's actually Intel's business, but essentially just all personal computers, right? And so they monopolized the personal computer operating system market. The judge ordered that Microsoft needs to break up the two companies, one for the operating system and one for the other software. What's interesting to note about here is that it was probably a bigger monopoly because not only was it the operating system, but on top of that, they had the Internet Explorer at the time, and they had the web browser, and they had the search engine, and they had the software of, the Microsoft Excel's, PowerPoints, all that type of stuff. And on top of that, they had the operating system, right? So you have essentially, you really have monopolized anything to do with the personal computer that isn't the actual hardware, like the HP or the Asus or Lenovo, whatever the case is, right? Like anything other than the actual hardware, Microsoft was the dominant company that was selling those softwares or whatever. And they did behave in monopolizing manners of kind of bundling it together and all that type of stuff, right? And so later on, Microsoft actually appealed the decision, which unanimously affirmed the monopolization ruling, but overturned the breakup order. And then in 2001, the DOJ and Microsoft settled the case, and the DOJ announced it would no longer seek a breakup. The settlement included Microsoft being prohibited from making exclusive deals that would hinder competition and being required to disclose more technical information to potential rivals. Now, I'm going to suggest that you guys listen to the Acquired podcast, where they went over, I think it was episode 2 of Microsoft, is where they really kind of covered the history of the lawsuit and all that type of stuff and really went into detail. It's 4 hours long, but I would highly recommend it. It's very, very entertaining podcast to listen to. With that being said, what I personally kind of get out of this is that it takes, first of all, it takes a very long time for them to actually kind of reach a settlement or reach a conclusion with it. But then on top of that, even when they reach a settlement, they could appeal it. And at the end of the day, Microsoft left with a couple scratches on their moat, right? They just weren't allowed to make exclusive deals. And then they were supposed to give some more information to potential rivals. If you can't tell, 20 years has passed since this, and Microsoft still is like a 95% dominant market share position in operating systems. And actually for personal computers, like desktops, it's probably even higher than that. And then for the software side of things, actually Google has came along and they're kind of competing with that side of Microsoft. But still, Microsoft holds a very frothy position in that side of their business as well. And so at the end of the day, it didn't impact them too much. And so when we're looking at Google with all these scary headlines, I personally don't really buy into the risk of this is going to materially impair Google forever. They're screwed. It's actually probably in the interest of the government to not mess with their highly powerful tech companies, kind of like too big to fail. It's probably in the best interest of you as a country to not mess with that company too much. Of course, at the end of the day, you want them to not be bad for your own citizens, but at the end of the day, like it's a global business with a literal monopoly power, and you want to ensure that you don't tinker with that too much so that they lose that monopoly power on a global scale. Keep the interest of society in mind and make sure that it's not abusing that power. You guys get the point here. And so just before we move on to the fundamental side of things, I want to point to literally earlier this year or like late 2023 when the narrative with Google, and again, this goes back to the whole narrative-based investing, just investing based off headlines and selling and buying based off headlines of all this stuff. Google was deemed that it's falling behind in AI, that the AI is going to counter our position at ChatGPT was becoming too powerful. And actually, even, I don't know, a couple months ago, people were saying, oh, Perplexity is going to ruin Google. There was a bunch of people on Twitter posting how they don't use Google search anymore. They exclusively use Perplexity. It's increased their efficiency tenfold, all this crazy stuff. The point is that I'm trying to make here is that narratives come and go. We live in a 24-hour news cycle, and it's honestly a fun game to try to pick the top on Google that, oh, this was the year where Google failed and it went down and it never came back. And this was the year where it got disrupted by the LLMs and all this crazy stuff, right? Like at the end of the day, these things come and go. These things have existed every single year that you could pick for Google's existence. There's been some risk factor. If you go back a decade, they said that it wouldn't be able to translate into mobile and the mobile revolution and all that type of stuff. Google wasn't made for it. It was a desktop only search engine. It's screwed, whatever, right? And so the point I'm trying to make with this is today's risk factor and the big headline, the big scary headline. I would probably bet that within a year, and I made this bold prediction over on Twitter as well, I said 12 months from now, nobody's going to remember about this. It'll maybe come up in a conversation once in a blue moon of, oh, remember, yeah, what happened with that case, by the way? Nothing really came out of it. And I could be wrong. Maybe they do eventually break up Google and they do force them to sell Chrome. But at the end of the day, I have a hard time believing, especially given the past couple years of me investing, like I've seen these things come and go. I have a really hard time believing that this is going to turn into anything. And then you add on the fact that Google trades at a 19 forward PE at the moment. If you want to do trailing PE, I think it's actually lower than this. It's like a 21 trailing PE. You have the S&P 500 that trades at a 31 trailing PE. You got Google at a 21 trailing PE. And then of course the S&P grows substantially slower than Google. I think it's frankly a no-brainer buy at the moment. And so if we jump over to finchat.io, I would like to kind of showcase to you that even though like in absolute terms, it's trading at a very low forward PE, if you actually compare it to the historical at which Google trades at, because some people argue, oh, well, yeah, Google's cheap, but it's always been cheap. It's going to continue to stay cheap. Even compared to Google in previous times, it's still trading at a massive discount relative to its historicals. So if we simply toggle on the average forward PE, you could see that the average over the past decade has roughly been 23.5. And today we're sitting at roughly 19 times forward PE. It's still not the levels that it was at the start of September when I was actually adding to my position. I believe just under like $160 a share. It was trading at like an 18 forward PE. And it's not at the levels that it was back in March, where in March, that's when I first initially bought Google at $132 a share. It was trading at a 16 forward PE. So we're not quite at the like pound the table, this is ridiculous, you need to run and borrow some money and put it in Google, not financial advice, of course. We're not at that moment yet, but nonetheless, relative to its historicals, it's a great time to be buying Google. Of course, you need to ask yourself, is the new risks that have came up with Google, are they material enough to the point where you need to assign a lower valuation to this business on a going forward basis? That's up for you to decide. And if I were to have you guys watching take away one like main thing out of all my videos, is go decide for yourself. You could watch all these videos, you could watch other people's videos, you could go read as many articles as you want, all that type of stuff. But at the end of the day, I think the most important thing in investing is that you need to decide for yourself, take all this information in and kind of make the judgment for yourself, build the muscle over time of being able to make that judgment over time of realistically, is this a good risk to reward for the foreseeable future for my own personal investment dollars? And don't fall into the trap. It's very easy to say, and I'm a victim to it as well. I didn't buy Meta Platforms when it was at $100. $100 a share. But it's very important that you don't fall victim to the narrative-based investing of the DOJ and ChatGPT. They're going to come and they're going to completely destroy Google. It's over for Google. I can't buy into it. Even though it's at an 18 PE, I can't buy into it. And you just keep making these excuses. There's always going to be excuses of why it looks gloomy, why it's bad, but you really need to hone in on the actual numbers and the actual statistical chances of these things happening and make, at the time, good investment decisions based off of the best available knowledge that you have. And then one last thing I want to highlight here on FinChat before we move on, I would like to talk about the total revenues, which actually re-accelerated. So again, this kind of goes back to, you might be told one thing, but then if you actually look at the fundamentals and the numbers, you'll see another thing. So if we, here, let me move these. So if you look at the total revenue percentage change, it's been comfortably re-accelerating ever since the bottom in middle of 2023. Actually, if we chuck this on a quarterly view, you'd be able to see that on a quarter-over-quarter basis, it re-accelerated back up to a 15% year-over-year growth rate. This was largely driven by actually, and we could do this if we go down here to, where is it? The Google Cloud revenue, which is arguably the most important part of this business. And so if you exclusively look at Google Cloud revenue, it actually re-accelerated up to a 35% year-over-year growth rate in the most recent quarter. By far and away, between the three hyperscalers, Amazon, Google, and Microsoft, by far and away the fastest growth rate out of all three of those, which is just absolutely incredible. This is likely going to either stagnate or perhaps re-accelerate a little bit more as we go on into the future here. With that being said, if you like the software that you've seen in front of you all video long, this is the most incredible stock research software that I use literally every single day. And right now they're offering 25% off their paid and premium plans, which you can sign up for using the top link in the description if you're interested in that. And so with that being said, to kind of close off this video, I want to talk about what I'm going to be doing personally with my portfolio, which you can check out using it's literally just pinned at the top of my page over on Twitter. The link of that is also in the description. Actually, what I'm going to do here, I'm going to switch to FinChat just to show you the more current version of it. This is as of today. I have very big positions in Salesforce and Amazon. They're very neck and neck for the number one spot. Actually, as of the past couple of days, Salesforce took over and is now my biggest holding, purely off the back of incredible gains with this holding over time, and actually Amazon going down a little bit. And so me personally, when it comes to Google, I was adding earlier in the year, initially in March when it was at a 16 forward PE. Then I added again in September below like 157 a share. I bought at like 148, 150, and 157, and I bumped it up to a 16% position. And so right now it's still a little bit above in terms of valuation. It's a little bit above where I like it. I think around the 18 forward PE, it really starts to be just a screaming deal. And then the second problem I have is I currently have absolutely zero cash, which is kind of a bad thing because I think the market is ridiculously expensive at a 30 forward PE, or sorry, a 30 trailing PE. So I'm kind of stuck in the middle here of like, I definitely think ASML and Google are currently undervalued by a wide margin, but at the same time, I would like to build some type of a cash position because I think in the next, call it 6 to 12 months, we're going to probably see a sizable pullback in the market. And I'd like to have cash to buy into businesses that I've been kind of on the sidelines for. Like for example, Meta platforms or like even like MasterCard. Like I'd like to build a more sizable position in MasterCard, have it 15% of the portfolio. So I'm kind of in the middle here of like, kind of in a push and pull of like, I don't know what to do, right? So me personally, I already have a pretty sizable position in Google, and I'm unlikely to trim some of these bigger holdings, even though I think like Salesforce is less undervalued than Google. I think Google's more undervalued. I'm unlikely to trim a great business to go into another great business. I just kind of want to let it be, let the compounding happen. If I miss out on a couple percent gains, then so be it. And actually my friend Ethan over on Twitter, which you should check out his page as well, he posts great stuff. I was speaking to him about it, and he was saying like, when it comes to trimming decisions, it should be like, if you think the company you're trimming is realistically going to give you like 5% returns per year for the next however long, and the company you're buying into is like 15% returns, then the difference of those two is big enough for the trim to statistically make sense. Realistically, expensive could continue to get more expensive, but if there's a very like obviously better company that you could buy into today, and you're not downgrading the portfolio, like the moat isn't that much worse, then you should make that trim decision. But if you're looking at Salesforce and you think it probably is going to return 12% per year from here, and Google's like 15% per year from here, realistically, that's not a big enough difference between those two for it to make sense. And so I completely agree with that line of thinking. That's probably what I'm going to be doing personally with my portfolio as well. With that being said, thank you very much for watching. Be sure to check out FinChat in the description down below. Again, it's a limited time Black Friday sale that they're doing over there, and those things only come once a year. Thank you very much for watching. You should subscribe because it costs you absolutely nothing, and have a great day. Maybe on the 9th attempt of actually trying to record this video, a bunch of stuff has happened. Vacuum went off in the background. I got multiple phone calls, multiple texts, everything. This will be at the end of the video, but anyways, welcome back. My name is Arya, and